Hello there. This guide comes to you from the expert tax advisors at ProTax Accountant, one of the UK's most trusted firms. And today, we're talking about something that every savvy investor should know about, the Enterprise Investment Scheme, or EIS. We're going to walk you through exactly how it works.
So, let's kick off with a scenario. Imagine Chloe, a tech consultant up in Manchester. She's had an absolutely fantastic year. But well, with that success comes a pretty hefty tax bill from HMRC looming on the horizon. It's a problem a lot of successful people face, right? Now, Chloe is really keen to support the UK's amazing startup scene. She wants to invest her money smartly. But what if she could do that and get a massive chunk of her tax bill wiped out at the same time? Well, she discovers a government scheme that offers exactly that, a staggering 30% of her investment back as direct income tax relief. Okay, let's dive into how this actually works.
We're going to follow Chloe's journey, step by step. We'll start with her tax puzzle, see how to unlock the relief, get that all-important certificate, walk through how to make the claim, and crucially, how to avoid the common mistakes that trip people up.
Right, Section 1, the investor's tax puzzle. You see, for people like Chloe, the goal is twofold. Number one, she wants to reduce her tax bill in a smart, efficient, and totally legal way. And number two, she wants her money to really work for her, to be part of an exciting, high-growth business story. The challenge is, how do you do both?
And here's the answer she finds: the Enterprise Investment Scheme. You can think of this as a powerful tool created by the UK government. Its entire purpose is to encourage people like you and me to invest in the smaller, innovative companies that are the lifeblood of our economy. But, and it's a big but, to really make it work for you, you've got to know the rules.
So that brings us neatly to unlocking the tax relief. Let's break down what makes the EIS so incredibly attractive. We've talked about that huge 30% income tax relief, but honestly, that's just the start. It's just the tip of the iceberg. Now have a look at this. When you put EIS side by side with another scheme, the Venture Capital Trust, or VCT, you see something really interesting. Yeah, they both offer that 30% relief, but check out the annual limit. With EIS, you can invest up to £1 million a year, or even double that, £2 million for certain tech-focused companies. That completely dwarfs the $200,000 limit for VCT.
And here are the other layers of value that make this so powerful. First, if you hold the shares for 3 years and sell them for a good profit, there's absolutely no capital gains tax to pay on that profit. Zero. But for me, the most important one is loss relief. Let's be real, investing in startups is risky. If it doesn't work out and the shares lose value, you can actually offset that loss against your income tax. It's a brilliant safety net that helps cushion the risk.
But we have to be completely upfront here. The authorities, the FCA, they classify these as high-risk investments. You absolutely have to go in with your eyes wide open. You could lose all the money you put in. And unlike a bank account, you're not covered by the Financial Services Compensation Scheme. This catches a lot of people out, so it's so important to understand these risks before you dive in. Okay, so Chloe's done her homework. She gets the benefits, she's comfortable with the risks, and she's made her investment. So what's next? Well, what comes next is probably the single most important administrative step in the whole process.
You see, you can't claim your tax relief right away. First, the company you've invested in has to do its own bit of admin with HMRC. After that's done, and it usually takes a few months, they'll post you a certificate. For most investments, this is a form called an EIS 3.
Honestly, just think of this piece of paper as your golden ticket. It's that important. Without it, you can't claim a penny. So here's a pro tip. The day it arrives, take a photo or a scan of it, and keep the original somewhere incredibly safe. You never know when HMRC might want to see it. Right, let's get down to the practical part. You've got your certificate in hand. How do you actually turn that into tax relief? Let's walk through the different ways you can make your claim.
So let's make this simple. The whole claim process really boils down to 4 steps. 1, you absolutely must have received your certificate. 2, you pick your method, which depends on how you pay your tax. 3, you fill out the right form. And 4, you send it off to HMRC. Simple as that.
Okay, so for most investors like Chloe, contractors, directors, self-employed people, the claim just becomes part of your annual self-assessment tax return. If you do it online, you just need to find the section for other tax reliefs and pop in the details from your EIS 3 certificate. If you're still doing a paper return, you just need to fill in one extra sheet. And here is what that extra sheet, the SA 101, actually looks like.
See, it's not as scary as it sounds. You literally just find the box for the enterprise investment scheme and copy over the key details from your certificate: the company name, how much you invested, and the date.
But what if you're employed and pay all your tax through PAE? Maybe you don't even do a tax return. Well, there's another way. Your EIS 3 certificate actually has a claim form printed on the back pages. You can fill that in and post it straight to HMRC. And this is really handy because they can adjust your tax code, which means you start paying less tax each month, getting your relief much faster.
Now, we need to talk about avoiding the common traps. This is where a lot of people get tangled up, and it is a critically important part of the whole thing. So stay with me, you'll want to hear this part.
Have a look at this. It's a real question from an investor online. They'd made some investments a while back and were worried they left it too late to claim. This highlights the #1 point of confusion when it comes to EIS: the deadlines. So here's the crucial thing you need to get your head around. There's a big difference between the tax year your relief is for and the year you actually submit the paperwork. Let me make this really clear. If you invested in, say, the 2023/24 tax year, you actually have until the 31st of January 2030 to submit your claim. It's a really generous deadline, and it's there for a reason: to give companies plenty of time to get those certificates out to you.
And here's another really clever feature. You've got flexibility. You can, of course, claim the tax relief against the tax year you made the investment in. Or, and this is a fantastic bit of tax planning, you can carry it back 1 year. Now, this is perfect for someone like Chloe. If, say, her income was much higher last year than this year, she can choose to apply the relief to the tax bill where it will save her the most money. It's a really useful option.
So, there we have it. Chloe has successfully navigated the whole process. She understood the risks, she made her investment, she waited for her certificate, and she made her claim, using that clever carryback feature to her advantage. Her journey really gives us a nice, clear summary of what you need to remember. So, let's run through your final checklist. 1. Always double-check the company is definitely EIS qualifying. 2. You must hold those shares for at least 3 years, or HMRC can ask for the tax relief back. 3. Be patient and wait for that certificate to arrive. 4. Keep it somewhere safe. And 5. Be really clear about which tax year you want to claim the relief. Of course, everyone's financial situation is different. What was the perfect move for Chloe might not be exactly right for you. And navigating these schemes to really get the maximum benefit, well, it does take careful expert planning. For that kind of expert, personalized guidance, here is how you can get in touch with the team at ProTax Accountant for a consultation. You can also find a fantastic, detailed article covering everything we've talked about over on their blog. And of course, please do subscribe to the ProTax Accountant channel for more helpful guides just like this one. And finally, just a quick but very important disclaimer. This has been for general guidance only. Tax rules can change, and how they apply depends completely on your own personal circumstances. It's always, always best to seek professional advice from an expert, like the team at ProTax Accountant, before you take any action.